Welcome back to the Discipline Edge. I'm your host, Alex, and today we're tackling a topic that is highly volatile, highly addictive, and frankly, financially devastating for most people, crypto futures trading. We see the headlines, the huge wins, but what about the vast majority who lose? To help us navigate this treacherous landscape, we have with us financial analyst and risk management expert, Ben Carter. Ben, welcome.
Thanks for having me, Alex. It's a pleasure. And I think we have an important conversation ahead of us because the truth about crypto futures is far less glamorous than the hype suggests.
Let's dive right into that truth, Ben. The data is brutal. Up to 90% of retail traders in futures markets end up losing their capital. Why is that number so high? Is the market rigged, or are people just bad at predicting Bitcoin's price?
It's neither, really. That's the biggest misconception. Most traders don't lose because they predicted the price movement wrong. They lose because of poor risk management. Think of it this way. Entering the futures market without a risk plan is like driving a sports car at 200 miles an hour without a seatbelt. You might be a great driver, but the moment you hit a curve, you're done.
That's a powerful analogy. And the thing that turbocharges that risk is leverage, right? Can you break down the lever metaphor for us?
Absolutely. Leverage is the core of the danger and the popularity. Imagine Archimedes' famous lever. Give me a place to stand and I will move the earth. In trading, your capital is that place to stand. If you have $1,000 and use 10x leverage, you suddenly control a $10,000 position. A small 1% price move means a 10% gain on your actual capital. Sounds fantastic.
Right. The quick gain is the hook.
Exactly. But here's the critical part. That lever works in both directions. If the market moves against you by just 1%, you instantly lose 10% of your capital. In a hyper-volatile market like crypto, where 5% or 10% swings in a day are normal, a small dip can instantly lead to a liquidation. That's the exchange closing your position automatically because your money is gone.
So if 50x or 100x leverage is out there, it's essentially a lottery ticket.
It is a recipe for disaster. Professional experience suggests starting with 3x or 5x or even 1x while you're learning the mechanics. The goal isn't the biggest possible trade, it's survival.
The heart of discipline, the 1% rule. Survival is the key word. So let's talk about the absolute foundation of professional survival, which you call the 1% rule. What is it, and why is it so non-negotiable?
The 1% rule is the protective shield for your capital. It states that the maximum risk you can assume on a single trade is 1% of your total futures capital, period.
Give us a simple example.
Let's say you have $10,000 in your trading account. Your maximum risk on one trade is $100. It doesn't matter how good the signal looks or what a friend told you. Why 1%? Because statistically, it allows you to survive a losing streak of up to 10 consecutive losses. And believe me, losing streaks happen to everyone. Without decimating your account, it keeps you in the game.
Right, it manages the inevitable drawdown. And this rule ties directly to your stop loss, which is mandatory, correct?
Absolutely mandatory. The stop loss is your insurance policy. If you don't use it, you're exposing your capital to those flash crashes. But it can't be arbitrary. It must be a logical stop loss, a price point based on technical analysis. If the price breaks a key support level, the logic of your trade is invalidated and it's time to exit. The 1% rule helps you calculate the position size so that when that logical stop loss is hit, your loss is exactly 1% of your account.
Trading like a sniper. The risk-reward ratio. That's where you separate the gamblers from the professionals.
Exactly. If you risk $100, your 1% loss limit, how much do you expect to gain? If you only expect to gain $50, your RR is 1 to 0.5. That is a terrible strategy because even if you win half the time, commissions will kill you. A professional trader only seeks trades with a minimum risk-reward ratio of 1 to 2.
So for every $100 you risk, you must target at least $200 in profit. Why is that ratio so crucial for long-term profitability?
It removes the psychological pressure. A 1-to-2 ratio means you can have a relatively low success rate, even 35 or 40%, and still be profitable overall. This is the confidence builder. It teaches you that a string of small losses is okay as long as your winners are big enough to cover them. The quality of your winners matters more than the quantity.
Shielding your capital, margin types, and psychology. Let's talk about some specific tools available on the exchanges. You mentioned the critical difference between isolated margin and cross margin. This sounds like something every beginner needs to pay attention to.
This is vital for survival. Isolated margin is your best friend when starting out. The margin for a position is isolated from the rest of your capital. If that position is liquidated, you only lose the money you allocated to that specific trade. The rest of your account is safe.
And cross margin?
Cross margin is dangerous. It uses your entire available balance in the futures wallet to cover losses, delaying liquidation. But if liquidation occurs, you lose the entire balance of your futures account. This is for complex hedging strategies, not for the retail trader starting out. Never start with cross margin.
Emotional and cognitive risk, the real black swan. Ben, let's zoom out to the biggest risk factor of them all, the human mind. The uploaded content touched on how the human brain treats a financial loss like a physical threat. How do we stop emotion from destroying our discipline?
It all boils down to avoiding the cardinal sins: revenge trading and greed. Revenge trading is what happens after a loss. You violate the 1% rule, use 50x leverage, and jump right back in immediately, trying to recover the loss. It's pure impulse.
So what's the actionable tip there?
Simple. Close the screen. Take a 30-minute to 1-hour break. You must cool down. The only way to defeat revenge is through the discipline of pausing. On the flip side, greed is when you have a great winner. Say it hits your 1 to 3 target, but you tell yourself, I'll wait for 1 to 5. Then the price violently reverses and you close with a minimal gain or even a loss.
The market taking back your profits.
Exactly. The lesson is a gain taken is capital. A potential gain is just a number on the screen. Whenever your position hits your desired RR, take partial profits and immediately move your stop loss to your entry price. We call that break even. Now you have a risk-free trade.
Practical application, the trading journal. We need a system to enforce this discipline. You recommend a trading journal. How does a simple document save you from a complex, volatile market?
The trading journal is your personal quality control system. It forces objectivity. You must record 4 key things before opening a trade: the reason for entry, the entry SLTP prices, the calculated RR, and the 1% capital risked.
And what about after the trade?
You record the result and, critically, how you felt. I'll give you a quick anecdote. When I started, I lost $500 in a week because I felt the market was going up. When I looked at my journal, 90% of those losses came from impulsive positions without a stop loss. The journal forces you to face the data and demonstrate your expertise in every single decision. It's the difference between gambling and systematic wealth building.
Conclusion: the 4 commandments of crypto futures risk. That's incredibly insightful, Ben. To wrap up, let's distill this into your 4 commandments of crypto futures risk, a checklist every listener should run through before clicking execute.
Absolutely. These are the 4 questions that build confidence and ensure survival. What is my total risk capital? This is the money you can afford to lose, separate from your survival funds. What is my maximum loss per operation? The unwavering answer is 1% of your risk capital. Where is my logical stop loss and my take profit? The stop loss must invalidate your trade thesis, and the TP should be at a realistic resistance zone. Is my risk-reward ratio at least 1 to 2? If the math doesn't hit 2.0 or more, the trade is not worth the risk. Wait for the next opportunity.
Fantastic. The message is clear. Success in crypto futures is not measured by the single largest gain, but by the consistency of your profitability over time. Thank you, Ben Carter, for sharing your expertise on the discipline edge.
My pleasure, Alex. Trade safely out there.
And to our listeners, protect the money you already have. That's the real first step to making more. We'll catch you next time.